Hi, we're back. I think we're waiting for some others.
I don't know why you will have to log off. Maybe you just put yourself in mute. I was first scared, like, how come everybody just leave me alone? Me too, I can't leave now. You don't feel late. Okay, Sheriff is back. Only okay, retire Sheriff, Brian. Then we're good. I think we're good. So I think the last part is just is the perfect the fourth part of that question. We explain our own on that. Where's the last part of the question? Where's the requirement? Don't the correct one. Okay, C is the this iron now. We're not talking about iron. We're talking about to stellar promotion of new product. That's what we're looking for. Say the VAT implication of number one, the expected increase in the turnover of Toscana Limited. What happened in that part? Then the entertainment and gifts at the promotional evening. So what do we do with Sky? We quickly look at the information we have on that. Do we have any information on the expected sales and the promotions? Promotions. Yeah, here we go. He said first thing that we note there is that it's account for VAT using annual accounting scheme. So okay. Even we don't know what. Yeah. Hello.
I can't see your screen. Have you shared it?
Oh no. I think I took my screen. I meanwhile I left the group when everybody left now. So like how can I be the only one remaining? Can you see my screen now?
Yeah. Yes, I can see.
Okay, good. So what we're looking for here, the first and said, yeah, the manufacturer qualified as global, the account for VAT using annual accounting scheme. The first thing, if you know anything or short thing about annual accounting scheme, you can put it down as an introduction before you start. At least we have something called annual accounting scheme there. And said Toscana has developed a new product which is expected to increase the company annual turnover from 1.2 to 2.0 million. So if you know annual accounting scheme, you should know that it has a condition before you can use the annual accounting scheme. And then the increase in sale definitely might affect the condition of the company using annual accounting scheme. So anybody remember anything about annual accounting scheme in VAT? Anything at all you can remember under annual accounting scheme?
The limit to enter is 1.35 million and must leave the scheme is 1.6 million.
Simple. That's what the examiner, that's what what's want to be tested here. It's 1.2, but now it's moving to 2 million. So it means that increase in sale will force Tosca Limited to go out of the annual accounting scheme because its turnover will now be more than 1.6 million. All right, so that's one key thing that we need to know. The new product is to be marketed to company customer, all of whom are UK-based retailer. Via promotional evening, various part of that one. Say here, the promotional evening, the retailer will be provided with a meal. They will also be giving a sample of a new product costing approximately £90. That's new product, and then a pen costing £40. So we have to talk about this stuff one at a time. The first one is meal. The second thing is a sample. And the third one is pen cost. Before we go to another accounting scheme, when you give your customer a meal, is it a deductible expense or not deductible expense? Entertainment of customer, people of God.
Yeah, it's a deductible expense.
How do you know it's a deductible expense?
Oh, it's not a deductible expense.
How do you know it's not a deductible expense?
Since it's a food, and it doesn't carry conspicuous advertisement of the company or something like that.
Okay, there are two of this entertainment of customer. One is for trading when you're doing the adjusted trading profit. One is for VAT, and I'll separate them. For individual tax, for adjusted trading profit, entertaining customer is not allowed. Most especially, it has a condition, and it said if it's a meal, it will not be allowed. It cannot be food, drink, or tobacco. Do you understand? That's for the trading, adjusted trading profit condition. For VAT purposes, it's a different rule. In VAT, we divide the customer into two, overseas customer and UK customer. If you entertain UK customer, it's not deductible. If you entertain overseas customer, it is deductible for VAT purposes. Now we are talking about VAT. Now check properly. Is it deductible or not deductible?
Not deductible.
Why?
Since it's UK customers.
Simple. That's what I want to hear. Number one is because it's male, and number two is because they are what? UK customer. If the Tosca Limited has entertained overseas customer, it will have been deductible. Despite that it's a me. So you have to watch out for that. And that's only applicable for VAT purposes only. For trading purposes, none of it will have been. We don't separate whether they are overseas customer or UK customer for trading purposes, but for VAT purposes, you separate it into UK customer and overseas customer. Overseas customer will be allowed. UK customer will not be allowed. Second one, sample. If you give them sample products, is it deductible? Sample products become a sample. Yes, sample is always alive. What about the cost of pen? £40.
Since it's less than 50, it's deductible.
Simple, since less than 50 is deductible. So we have finished that area. That's all that we need to explain in that part. First one is the most technical one, meal. Meal, everybody will get it because this time around, the examiner used UK customers. So even if you bring up the idea of from the adjusted trading profit, your conclusion will still be right because it's not allowed for trading purposes, whether UK, but if I'm the examiner, wicked guy like me, I will have put that they are overseas customer because I know people will come with, that idea from trading and they will have entered OSA straight. And that's one of the reasons why the examiner actually mentioned whether the customer are overseas or UK based. Do you understand? Normally, you won't mention, we'll just say your customer. Because it's for VAT, you need to make conclusion in relevance to either their UK customer or their overseas customer. That's why it has to mention that as well. So here, somebody help us with the condition. Okay, but you even mentioned the other time. First one is VAT, then we'll talk about annual accounting scheme. If you have not read it before and you are writing an exam, make sure you review your annual accounting scheme. What is that in again? Is it cash accounting scheme is the second one? There are three of them. Annual accounting scheme, as a cash accounting scheme, and flat rate scheme. One of them always come out, but it's always been between annual accounting scheme and cash accounting scheme. And sometimes you have to do your capital goods scheme. Those are the area that you need to be ready for when you're talking about VAT. And VAT most likely will always be part of corporation tax questions. The company to VAT returns. There is a payment on account. I don't know if you guys remember this one. Payment on account. Payment on account of 10 equal installment. Any call is starting from the 7th month, I think. Yeah, from 4th, 2nd. I know this 10 equal installments. No, remember that one. I think yeah, from 7 plus 10, but the final one is paid. That's 2 months after the accounting period or 4 months after the accounting period. I think the other one starts with that 2 and 4. I can't remember it properly now. But you always have a 10 equal installment. 10 equal installment, and the final payments is made after the accounting period. So I can't remember vividly now. And the final payment. The accounting period. You can check that period for yourself, the accounting period, the condition to qualify for that. Condition to annual accounting scheme. Number one is that the taxable turnover. Turnover 3.5 million, 3.5 million, right? 1.35 million. VAT return will be up to date. I must leave the scheme. And when the taxable supply exceed 1.6 million. This scheme and taxable supply exceed 1.6 million. So we'll now talk about Toscana now. I don't know why I'm calling that guy Toscana, but whatever. The guy, Toscana. Just put Limited. We have to leave the annual accounting scheme. The taxable supplies. The taxable supply is going to exceed that's going to exceed 1.6, right? If you leave the taxable supply, so how would it now be? How would it now be? How would it now be filing for tax? So therefore, again, it's VAT returns every quarter. Do anybody remember when the payment on account for annual accounting scheme will start? When does it start? Hello, people of God.
April, 4th month.
4th month, right? April. Then when is the final payment being made?
10 state payments. That 4th month to like 12.
And then that's the final payment 2 months after the accounting period, right? When is it?
Yeah. It must be made around 2 months after the accounting period.
Yeah, Shano is saying 410. The seventh one I'm remembering is the installment payment for corporation taxes for payment. All of those points are needed to be remembered, which is good. So instead of making one tax a year now, then I have to be making tax now every year because the tax supply has exceeded 1.6 million. So you have to get out of another accounting scheme. Boom. Gift and we're done with another accounting scheme. Then we'll talk about gifts. Gift and what's that thing again? I'm using my drugs. Gifts and entertainment. Example is a valuable expense, like we have discussed. Is unallowable. And there won't be need to make an output file on that. And approve that. We mentioned the other one too. Gift of pen. And it's less than £50. Oh, out. What's the other thing that we have here again? Entertaining customer. Entertaining of UK customer. Tosca was in Tosca. Because the application because and okay, we go to Sprint Limited and Ion Limited. Sprint and Ion. Who is going to help us read Sprint and Ion?
So actually, you were solving one question in the last class that we not finish.
Which one's that?
I think it's limited or something.
It.
In that document you sent, that last class.
Which one is
This
it?
last question, yeah, I think
This
this
one.
one.
Did you start it?
Yeah, it's good.
Did you
Yeah, I
start
think
this one?
it.
Where did we
Yeah.
stop?
I don't. That's good. You can check that your document, your PDF.
We can't go back to it because there are one or two people that were not in the last class. So
Oh, okay.
they said we have to now start from the beginning again. It wouldn't make sense, right?
Yeah.
It wouldn't make sense.
Let's just go with your Spring Limited.
Spring and Iron Limited. It's not my own. Okay, it's great to have one with Spring and Iron Limited. I forgot that. I thought we finished everything. You know, immediately I left the class that day, I had to go out because I was enjoying my money, saying make money, spend money, enjoy money. People have got somebody help us read Sprint and Iron Limited. I think Sheriff did the first. So, can Ibrahim help us this time? Let's see whether his network is back. He was trying to read your data, but the network was stopped. Ibrahim, is your network good now?
I think so.
Okay, yeah. You can go ahead and help us with that.
Okay. So let's talk about that again. Carry out the work required as requested in the email from your manager. The following marks are available. Iron Limited Corporation Tax Payable. Note, the following figures from the retail price index should be used when necessary. June 2017 to June 2017, 0.021. B, ownership of Iron Limited. C, value added tax registration. So over to the question. Sprint Limited and Iron Limited. You should assume today's date is 1st of September 2022. Your manager has received the letter from Christina. Christina is the managing director of Sprint Limited and owns the whole of that company's ordinary share capital. Sprint Limited is a client of your firm. Extracts from the letter from Christina and an email from your manager set out below. Extract from the letter from Christina. I intend to purchase the whole of the ordinary share capital of Iron Limited on 1st of November 2022. My company, Sprint Limited, purchases components from Iron Limited, so the two companies will fit together well. I hope to increase the value of Iron Limited over the next 3 to 5 years as a active profit. I need the advice on the following matters. Corporation tax payable. Iron Limited has not been managed particularly well. It has had significant bad debts and as a result is in need of more cash. To help determine its financial requirements, I need to know how much corporation tax Iron Limited will have to pay irrespective of its results for the 16-month period ending 30th June 2023. Iron Limited's tax adjusted trading is on here. In fact, if we discover further problems, it is quite possible that Iron Limited will make a trading loss for this period. But please base your calculation on the budgeted profit figure of 30,000. Iron Limited has no income other than trading income. Following the acquisition, Iron Limited will sell a small industrial building for 160,000 and an item of fixed machinery for 13,700 on 1st of December 2022. The industrial building and the item of fixed machinery were both purchased on 1st of June 2017 for 100,000 and 13,500 respectively. At that time, rollover relief of 31,800 was claimed against the acquisition of the industrial building and 3,200 against the acquisition of the item of fixed machinery. Ownership of Iron Limited. I need to decide whether I should purchase the shares in Iron Limited personally or whether the shares should be purchased by Sprint Limited. I'll be the managing director.
You didn't get back to me yesterday. What happened?
Purchasing the shares. My preference. Sorry.
Okay. It's okay. Tell me.
Ibrahim, can you continue? I think it's on the call or something.
Okay. I need to decide. Okay, my preference would be to own Ion Limited personally. However, I would be interested to learn of any advantages to the company being owned by Sprint Limited. When Ion Limited is eventually sold, I intend to use it to purchase the holiday home immediately. Value-added tax.
No.
Ion Limited is not.
Which name now? The name on the
VAT.
document or the name on the address? Okay, change the name now. I'll give you another name. Take it to Maori. I will change the name. I will remove it. Don't go to DHL again. Maybe you go to FedEx or something else, but I'll give you another name to use, right? Yeah, I'll just use my middle name. Don't worry, no problem. I will use another name. I'll use my middle name. Don't worry. I'll send you my middle name. I'll let you know. All right, thanks.
Okay, value-added tax. Ion Limited is not registered for the purpose of VAT. The current management company has told me that the level of bad debt is keeping the company's cash receipts in a 12-month period below the registration limit of 85,000. However, I said that when I have the opportunity to look at the figures in more detail, it will become apparent that the company should be registered. Extract from email from your manager. Additional information, number 1. Sprint Limited owns the whole of the ordinary share capital of Olympic Limited. Both these companies are profitable and prepare accounts to 30th June each year. Both companies are registered for the purpose of VAT. Number 2, Sprint Limited, Olympic Limited, and Ion Limited are all UK resident trading companies. 3, Sprint Limited will sell a warehouse on 1st of February 2023. This will result in a capital loss of 38,000. 4, Ion Limited currently makes up its accounts to 28th February each year, following its acquisition. However, its next set of accounts will be for the 16 months ending 30th June 2023. Number 5, Ion Limited currently has no 51% group companies. Please carry out the work set out below. There will be quite a few points to draw to Christina's attention, so keep each one fairly brief. A, Ion Limited Corporation Tax Payable. Assuming the entire ordinary share capital of Ion Limited is purchased by Christina personally on 1st of November 2022. Calculate the corporation tax payable by Ion Limited in respect of the 16-month period ending 30 June 2023 and state when this tax will be due for payment. The ownership of Ion Limited. Explain the tax matter which Christina needs to be aware of in order to decide whether the ordinary share capital of Ion Limited should be purchased by herself personally or by Sprint Limited. You should assume that Ion Limited will be required to register for VAT. You should consider the tax implication of both the ownership of Ion Limited and the eventual sale of Ion Limited by either Christina or Sprint Limited. You should recognize that regardless of who purchases and subsequently sells Ion Limited, Christina intends to use the process for personal purpose, and that she is a high rate taxpayer with a substantial amount of investment income. See VAT registration. Set out the matters which Christina should be aware of in relation to the need for Ion Limited to register for VAT and the implication for that company registry rate.
Thank you. Although we have a lot of background noise, but what can we do? We can only take that like that. So first thing we need to do, we'll just go to the requirements. Requirement is easy. Say for Ion Limited Corporation tax payable, assuming the entire ordinary shares of Ion Limited is purchased by Christina personally in November, calculate the corporation tax payable by Ion Limited in respect of 16 months to 2023 and state when this will be due for payment. Calculate corporation tax, we mentioned that in class. If it is more than 12 months, what do? People of God. Corporation tax calculation. I even did something like that in class. We have to divide for first 12 months and the remaining months, right?
Yeah.
First 12 months and the remaining month. That's how we always do. We break it down to first 12 months and the remaining month. And that's how we have to going to calculate our corporation tax payable for these guys. First 12 months, remaining months. And that's quite easy. So And then we assume that it's going to be owned, by Christina. So we have first 12 months and remaining month. Year ending, personally on November 2021. So we're first focusing on this one, that's June 2023. That's 16 months ending June 2023. What are the informations that we have for that? That's the corporation tax payable. Okay, corporation tax payable. And the amount of profit it's going to make is actually £30,000. The amount it's having is £30,000. So we have this to be, where's my stuff again? Corporation tax payable. Who's paying the corporation tax now? Which company is Ion? So Ion Limited. Ion Limited corporation tax payable. Payable. Ended. And the 30th June 20. So we divide it into first 12 months we end when? It's 16 months will be 12 and 4 months. So for us to have 4 months, it will be from February, March, April, May, June, ending June. So that'll be ending February. So 8 February. You said what?
Yeah. I said March 1st, the same thing you said. March 1st.
Yeah, March 1st, yes, exactly. It's a period ended. Period ended June 30. 2020. Trading income. That also will be time apportion because the total profit that we want the guy to make is actually 30,000. That's what we assume that it's going to be. So we should please base our calculation on the budgeted profit figure of £30,000, and that's what we're going to do. So £30,000, we're going to operate it with 12 months and 4 months, isn't it? Out of total 16 months. So the first guy is going to, and the first period is going to earn 30,000. Apply by 12 upon 16. The second guy is going to get 30,000. By, is that 4.16? 4.16. 12.16 would be equals to how much would that be?
7.5 and 22.5.
Okay, that'll be 22,500 then, because 12 is more than that. And then now will definitely be 7.5. We'll go and see what other information we have. Things is looking like there's going to be chargeable gain. Say make a gain of 160, sell something for 160, sell machinery for 13,700. You can calculate chargeable gain for both of them, isn't it? Chargeable gain. Chargeable gain for the industrial building is going to be what? Then it has, we're both purchased 100. So 160 minus 100 will give us how much? Minus 100, but they have a rollover. This one has a rollover of 13,800. So anytime that has a rollover, I want to focus on the building first. So anyone that has a rollover, you always use what we refer as the base cost. So I'll come in and say chargeable gain for industrial building. Industrial building. Yeah. How do you calculate that? That'll be proceed. Proceed is how much? 160. Remember that. Minus base cost. Anytime there is a rollover, use the base cost, and the base cost is always cost minus rollover relief. How much is the cost? Cost is 100. Rollover relief is 31. 100. That'll be the base cost. So that'll be 100 minus 31,800, I think. What would that give us? 60 something 200.
60,200.
60 what? It's not up to 40 now. About your 30. 68,200 makes sense.
68,200.
Yeah, that makes sense. 68,200 makes sense. That's the base
But the
cost.
second one, no, you move it.
Which one?
The second one, they invested in depreciating assets, so it will just be frozen and it will be chargeable now.
Yeah. I'm not looking at that yet. When I finish this one, then I'll go to the second one. We will not remove it, you're right, because it's a depreciating asset. Or why do you think we're not removing it?
Yeah, because it's a depreciating asset.
Yeah, and there are two examples of depreciating asset. I'm going to mention when I get there. The first one is fixed plant and machinery, is a depreciating asset, and then the leasehold building. They have used that one to catch to them before because people always feel like, oh, building is not a depreciating asset. But when they say leasehold building, it's a depreciating asset. You depreciate that leasehold according to the year of the lease. So if the lease is 30-year lease, then you are depreciating the asset for 30 years before it becomes yours. But this one is a plant and machinery. It's straightforward. We're going to freeze it. We're going to freeze it. It's frozen already. And when it's frozen, when do you now charge it? There are three conditions, three conditions when you charge that a frozen asset. When and when? When is that charged? The frozen asset. When does it crystallize? When does it crystallize? Three. Does Anna give us three reasons or three times when them? When the asset is what?
10 years from the acquisition.
The disposal of the new assets, the date.
10 years from the acquisition, and when the trade cease to use it
as a business asset. Yeah. And when it's actually also disposed either than the 10 years, yeah, that's those times that it has. When the asset is being disposed to as well, it crystallizes to as well from this frozen nature. So this one now, will it qualify for indexation allowance? Let's check. Is it before 2017 or after 2017? And that's very key. This is June 2017. So it's within 2017. So to 2022, they bought it from June 2017. So we can actually look for the indexation from June to December, because December 2017 is when that indexation allowance actually stopped. You can see from June to December is given 0.21. So from there, we can get our what do you call it, indexation allowance. Okay. Indexation allowance. So indexation allowance will be 68,200 times, what's that in again? 0.021. Is that it? 0.021. That's it. What would that give us? We can take that one to out. 68,200 multiplied by 0.021.
1,432.
Say again?
1,432.
1,432. 1,432. What will be our gain? Kini rewa. What is our gain? Chargeable gain. Chargeable gain. Kini rewa. What is our gain? Give it to me now. Give it to me now. To me now. Give it to me now. Give it to me now.
9368.
9 what?
9368.
9368. 9368. That's a chargeable gain. So why are we adding into the first column and not the second column? People of God. Why do we think we are doing that?
Because it pertains to that first column period of our account.
How do you know?
The date
How do
was
you know that it
disposed.
pertains to the first one? Oh, when was it disposed? That is key.
First December 2022.
1st December 2022. So that particular date of disposal is within the first period. If it has been disposed, say, in March or April, we'll have added that chargeable gain to the second period. So it depends on the date of disposal. Date of disposal is within the first 12 months, and that's why we're adding that chargeable gain to that. So we go for the third one, machinery, fixed plant and machinery, and say that particular gain is frozen. Fixed plant and machinery. Fixed plant and machinery. Crystallize gain. Crystallized. Is the gain that is being crystallized that was frozen before. Egole. Because they have disposed it now, the gain, the crystallized one will be frozen, which is 3,200. Is that correct? But then we can ask whether there is another gain or not. But the first one will first crystallize for us, and that will crystallize 3,200. And that one is also within the first 12 months, that's it. But let's calculate the chargeable gain of fixed plant and machinery. Disposal proceed. What did I use for this one? Is it proceed or did I use here proceed? Proceed for the plant and machinery. It was sold for how much? 13,700. Purchased for 13,500. 13,700. Cost. This one won't be base cost because there's no rollover. The gain was actually frozen to the earliest off. And that's how the examiner put it. And that would be 13,500. That gives us a gain of 200, right? I can look for indexation here. Indexation. Look for indexation on this one. Indexation, how do we calculate the indexation? Here is 13,500. Do we have the indexation allowance for this as well? The same thing, June to December. I think we're going to use the same indexation allowance. Same dates, so still the same indexation allowance. The indexation allowance here is going to be multiplied by
284. But limited to 200.
Yeah. So limit it to the maximum so that it doesn't create an extra. 284 limited to. $284, you call it, right? 284.
Yeah, 284.
284 limited to. So that means there won't be any gain in this one. That will be 0 for sure. Chargeable gain. Index gain. I think that's all we have. So what we're going to have is going to have the total taxable profit. Taxable profit will be equals to when we add everything together. This all 22,500, 93,68, 3,200. I know the second one without using calculator. The second one is going to be 7,500. But the first one, what would it be? What are you doing? Come back here. Taxable total profit.
116,068.
116.
068.
068. With the corporation tax payable.
Times 19%.
At 19%, right?
2205. Yeah, the first one.
1 minute. I don't know why these things. You stop writing everything. Let's give us Egoli
22053.
53. Second one multiplied by 19%.
1425.
1425. Due date. Before we go to due date, let's go to the tax threshold. To see whether it's going to pay installment or pay once. Tax threshold for the first guy is a 12-month period. And then we are saying that it is what do you call it? The name of the Christiana that is owning that particular company personally. So if Christiana is owning the company personally, that means that there won't be any relationship between Sprint and Ion Limited. If it is Sprint Limited that owns Ion Limited, then we'll have said, okay, our number of subsidiaries will have been 1. We'll divide the threshold by 2. Do you understand what I'm saying? Since it's been owned by that one, we only look at the time period. For 12-month, threshold is 1.5 million. For 4 months, threshold will be because what? Threshold will be 1.5 million, 4 over 200 times 4.12. What would that give us?
$500.
So this is 500. So if they are below, if the taxable total profit are below this threshold, it means that they are going to be paying once, and that once is always 9 months, 1 day from the end of the accounting period. So for the first guy, can we calculate 1 month, 9 months, 1 day from this time? Then 9 months, 1 day from this time. 9 months, 1 day will be when? For the first guy. Nine months, 1 day.
December 1st.
December 1st or 1st of December. 1 December. 2023, right? Or 2022?
23.
What about the second guy?
April 1st, 2024.
2024.
Yeah.
Yeah, that's it. That's it for that. I don't even know see as I be use word like this. I'll have just gone to my Excel JJ and be happy. If that is number 1, we go to number B in a jiffy. Just give me 1 minute. Let me use the washroom. I'll be back. Then we'll talk about number B part of it. Where's my water first? Come on.
Hey, Afi, I can't hear you.
My glasses. Okay, let's look at the second one, guys. Explain tax matters to Christiana need to be aware of in order to decide whether the ordinary share capital of Ion Limited should be purchased by herself, personally, or by Sprint Limited. Or by Sprint Limited, you should assume that Ion Limited will be required to register for VAT. Should you consider the tax implication of both? Ownership of Ion Limited, eventual sale of Ion. So first one, ownership of Ion Limited. And then we want to say we should assume that it is purchased by Christiana personally or by Sprint personally. If it's being purchased by Christiana personally, what will be the advantages of doing that? People of God.
So come again, what you say?
We have two companies now. We have Sprint and we have Christiana. Christiana is thinking about buying Ion Limited personally. So the examiner wants to see which one should he go for. Should Christiana purchase the Sprint personally, or should Sprint purchase the Ion Limited? Who should purchase Ion Limited out of Christiana and Sprint Limited? So the first question we're going to look at is that, okay, what will be the advantage if Sprint purchases it? What will be the advantage if Christiana purchases? Then we'll make conclusion. Who should we think should purchase it? So now, first one, which one do you want to take out of the two? If Sprint purchases it, what are the advantages? If Christiana purchases it, what are the advantages? Shoot.
Okay. If Sprint purchases it, there will be 75, they will be in a 75% capital gains group. And that loss, Sprint incur the capital loss, they need to transfer it. And subsequently, if Sprint also purchases it, all this rollover relief will be treated as one to gain all those relief. And they will be in a 75% group relief too. So whereby trading losses, they can relieve it to each other. But
that's good. But what about if Christiana purchases it? What will be the advantage of that?
Okay, if Christiana purchases it, she won't have to share a capital allowance and AIA with. She won't have to share
with that. So each of them will qualify for 1 million AIA, right? That won't be divided by 2.
Yeah, it will be divided by 2. And since it doesn't have any 51% group currently, you will most likely not pay corporation tax in installments, since it won't, the threshold won't be divided by 2.
Simple, yeah. So that two things they are going to discuss. We discuss the AIE, then we'll discuss the threshold. That makes sense. For the other one, we discuss all the advantages of the group. For both of them, I think one thing for both of them is that whether it is owned by Sprint or owned by Christiana, they can still enjoy VAT group, where one of them have to file for VAT in respect of the other one. So, which is good. So we'll just summarize that. Christiana owning personally, No, I'll go for Sprint only personally anyways. Do you know why we are concluding for that? Because he said it's possible that Iron might even make further losses, and it might even be making further losses in the future. So if there's going to be loss in the future, then it's easier for Sprint Limited to just own it, and then it could be relieving that particular loss, and the group corporation tax payable will always be reduced on a yearly basis when Iron Limited actually make a loss. Limited. Number one, what is first thing I say? Number one is transfer of what do you call that thing again? Yeah, Springtime will be in 75% trading group. Unlimited. 5% trading group. Will be in capital gain. Capital gain group. What is the third one now? Rollover relief. Capital gain group. Rollover relief. Replacement. I'm doing a business asset. What was the third one we mentioned? What's the third advantage we mentioned? So they can
Capital
transfer. We mentioned capital gain group and rollover relief, right?
Yeah.
Capital gain rollover relief trading group. That's it. Although the what do you call it? The AIA group remain 1 million. Against 1 million each for each company if owned by Christiana. As again, 1 million each. 1 million each for Sprint. Sprint and Iron Limited. And yeah. That's an disadvantage. The second one we mentioned is the threshold, right? Said the threshold for also be divided if owned rather than 1.5 each. if owned by Christina. This would probably the company is corporation tax on an installment basis. So all we just need to just give example while we're trying to make our point from each of this one. That will be good. I think there's one more thing that needs to sale of Iron Limited. This is who purchased it. So whoever purchased it now, we're gonna have to talk about when they now eventually sell it. The guy said if she wants to use the money to buy purchase or credit sale of I intend to use the proceeds for personal purposes, and she's a higher rate taxpayer. I think it was saying somewhere that I want to buy a house somewhere. That's what they do here. They'll be buying a house up and down. How's that? They will just stay for 2 days or 3 days. So, you. For example, let's say you want to purchase a holiday home in Italy, in Sicily. You want to go and purchase holiday home in Italy. So anytime it's in Italy, you go to that place and live there, holiday home. You can see that in Nigeria too. When what's this Otedola's daughter who say he's going to France in his father's house that is close to Monaco Grand Prix to go and read because you want to read alone. I go to their house, holiday home in France to read. Some of us are reading under candle inside our own house. They are going to holiday home to read. It is good. So let's take it one at a time. If it's been owned by Christina, what will happen when they sell it? What will happen when they sell it? If they do sell it, what will be the advantages of that, and what will be the disadvantages of that? If the Iron Limited is owned by Spring and then disposed. Iron Limited. That first thing we'll discuss. Iron Limited. It's owned. Yeah. And then disposes. What will be the advantages of this one? If you dispose the shares of after owning, if you dispose the share, will the share be charged to? Will it qualify for chargeable gain, or will it be exempt from chargeable gain? What do you guys think?
It will qualify for chargeable gain.
It will qualify for chargeable gain. Does it have any relief that it can enjoy?
Yeah, BADR will be available.
Say that again?
Since you have more than 5%. BADR, entrepreneurial relief.
Okay, entrepreneurial relief, that's what I used to call it. I think they changed it to another name, business assets, something relief, right?
That relief, yeah.
Yeah. What are the conditions for that? Those are kind of things we have to mention. What are the conditions for the entrepreneurial relief to be applicable?
She has to own the shares for 3 years. She has to be an employee in the corporation. It has to be a personal property where she has more than 5%.
Do you say 3 or 2 years? Do you say 3 or 2 years?
2 years.
You said what? 2 years, yes. 2 years, 5%, and it must be a director, of that company, isn't it?
An employee or
that. An employee or director. What do you call the relief again?
Business asset disposal relief.
Business asset what?
Disposal relief.
Disposal relief. Okay. Christina, yeah, that's cool. Christina, we enjoy BDAR. Bada. That's called Bada. Christina, we enjoy Bada. Yes. She own more than 5%. A period of months, and she's a director in the company. She already mentioned that she couldn't be a director in the company. So what's the advantage of that? The advantage of that is only that the chargeable gain will be paid at 10%, isn't it? Is that it?
Yeah. Yeah.
So chargeable gain is paid at 10% for entrepreneurs relief. It's still not changed. It's been like that for you.
May also be available also.
Okay, yeah, chargeable gain. We paid at 10%. Despite Christina, let's say Esther. Investment. They say it has some investment income. So annual exemption will also be available. That's what you mean, right?
Yeah.
Annual exemption.
Yes.
Will also be available. How much is the annual exemption?
12,300.
Is it 12,000?
12,300.
12,300. Can you share? So you can share number of what I can share. Okay, 300. I think that's not about it. That's what's going to be. It's going to be 10%. With that 10% on the tax. 10%, whatever your level of income something is, whatever gain you have, you're going to pay 10% on it. You enjoy annual exemption. So again?
I said that 10% is for the first 1 million.
Oh, is it for after the first 1 million? Yeah, that's true. It's for the first 1 million. We don't know how much this guy is actually going to guess if we can get it. So after 1 million, how much will you pay? 28%?
20%.
20 what?
20%.
20%.
Yes.
Yeah, that means that's reduced from that 20%. 10%. That's why we're on the first 1 million. Let me just mention that the first 1 million. I don't know what I did. 1 million yesterday. The first 1 million gain, right?
Yes.
And 20% afterward. Maximum 20% afterwards. Share it real quick. Yeah, so that's Christina owning it and disposed to share. What about if it is this other guy that owns and disposed to share now?
If Sprint disposes the share,
And
it will be
what would that be? That'll be what?
SSC exemption since there are two companies are a trading company, and it has over 10%.
And it's going to only 12
months.
12 months we didn't. So we have to use star to mention the SSC condition here too as well, just like we mentioned the other one in this space. So I just say SSC exception. SSC, Sprint Limited. We hold more than 10%, at least 12 months. Past 6 years. Oh, within the last 6 years. In the last 6 years. That means there won't be chargeable gain tax on that. This means no chargeable gain on the disposal. So how will Christiana retrieve the money so that I can buy the house?
She can collect the money through like a bonus or a dividend, but both dividend variable says 32.5% is lesser than 40%.
Come on,
man.
That's true. I don't go collect which bonus with that, so I don't want to collect. We collect bonus last one. We'll give you Kapoa of 45%. So normally, you see, what people will now do, especially in Nigeria, I don't know the practice in the UK, is that they will ask the company to go and buy a business asset in Italy. They'll say they want to be using it for Airbnb, so you will not be going there to use it. Do you understand? Hello?
So shall come again.
If it's a Nigerian businessman, the best way to manage it is for you to ask the company, Sprint, instead of collecting the money, either dividend or bonus, no. You will not tell Sprint, go to Italy, that house that you should have bought yourself, you ask the company to buy it. And tell them you want to, and the company will say they want to use it for business, like Airbnb or for rental. Do you understand? So that since it's holiday, anytime the guy just want to visit the place, the occupants will leave or they will not make it available for Airbnb that time. He will use it. Is it not holiday? And he will go back. By so doing, he will not pay any tax. True. Why does he want to pay a tax like that? The only time he want to pay tax, you're probably going to be like property tax. Property tax, by the time company want to pay property tax on it, you'll probably be paying 19%. I think the commission tax is 19%. That's the highest you will pay. So can you see, if assuming the examiner say we should discuss any tax savings, something, that's what we will say. We say, they should use it for furnished or letting in Italy. Anytime the boy want to use it, you should go and enjoy it and come back. The company will still be paying 90%, which is far, even better than either him selling it. If he sold it, he will have paid like, okay, 10% is still okay, but then, you won't have any 19% on that. That's the highest. And then they'll be making money from it instead of being idle. That can be a tax advantage for that. Then we have to take the fund via dividend or bonus. I like that bonus. But the dividend option. Cheaper since Christina. The tax at is it 32.5?
Yeah, 32.5 is the highest tax rate.
Instead of 40%, right?
Yeah.
Or 38.1% instead. Nice, man. Instead of down at 5%. How's that kind of thing we're going to discuss, right? But from your perspective, looking at both purchasing advantages and disposing it advantages, which one do you think we should recommend for the client? Do you think, looking at this now, do you think Sprint should own it or Christiana should own it? In conclusion, your personal conclusion now, not for the examiner, personal conclusion. What do you think we should do or they should do? What will you recommend that they should do?
That Christina owns it.
Mm-hmm. Christina owns it
because
of the eventual disposal. Or because of
yes, because of eventual disposal, and that we are eventually going to sell it very soon. It means we'll not be able to benefit from all those trade loss relief for a long time. And trade loss relief is like 90%. They might not have a trade loss in that period. And that way we'll still be splitting our capital allowances and probably be more likely to be paying corporation tax in threshold. I'll be in installment.
That's right. That's right. Do we still have anything on this one? I think we'll be able to VAT. Set out the matters which Christiana should be aware of in relation to the need of Ion Limited to register for VAT and the implication for that company for registering late. So how do we know that? Do we have anything on VAT here? Ion Limited is not registered for VAT purposes. Why? The current management of the company has told me that the level of bad debt is keeping bad debt busy. Is that not busy? Bad debt is keeping the company cash receipts in a 12-month period below the restriction limit of 85. However, I suspect that when I have the opportunity to look at this figure more in detail, it will become apparent that the company should register. What do you need before a company is registered for VAT? Hello, people of God. How do you determine if a company should register for VAT or not? Is it cash receipt or taxable supply? Which one?
When it's taxable supplies.
Yeah, so why is this guy now using cash receipt? What concerns cash receipt and taxable supply? What concerns cash receipt and registration? Do you think his argument is valid? Or we should say, no, you don't look at cash receipt and bad debt to check whether you are going to register with VAT or not. What you need to look is your taxable supply, except, excluding capital supply, excluding sales of capital assets. If it is, up to the registration limit, I think the registration limit is 85,000, is it?
It is.
Yeah, it's up 85,000. Boom, register. It doesn't. We don't care whether somebody owe you money or somebody does not owe you money. Bad debt and cash return. Somebody is not what we use to check whether somebody is registered for VAT or not. We look at the taxable supply, and that taxable supply must exclude any sale of capital assets. Immediately it reaches registration threshold or registration limit. Registration limit, I think, is £85,000. Then you must register. When are you supposed to register? Within how many months? When you hit that 80, within how many months are you supposed to register for VAT? People of UAR.
Within 12 months, I think.
Within 12 months, no, but about it, but you.
As when your future cash flow, taxable supplies.
Yes, has hit. When it has hit, you see that, okay, now my taxable here has hit £85,000. When are you supposed to register?
The following month, 30 days after.
Yeah, within 30 days. Yes, you must register within 30 days. Immediately you realize that, okay, I have to pay 85,000, we'll meet the registration. You must register with it. You must, even if they say you must inform HMRC and register, you have to call HMRC. HMRC, come here now. I have hit this registration limit, and you must register within 30 days. If you don't do so, what happens? If you don't do so, what happens? People of God. What are the penalty of registering late? That's what the examiner wants us to find out. Does it need to register? Yes, it needs to register. You don't look at that one. That's the argument we're going to make. You don't need to look at the cash receipt of bad debt. You look at taxable supply, less sale of capital assets. If you really meet the registration limit of 80,000 within 12 months, you must inform HMRC and register within 30 days. You stop there and you go ahead. If you do not register within 30 days, now, people of God, what happened? And you pay a fine, the fine for late registration. All right, we fine for late registration, and I can't remember those late registration fine again, but just there'll be penalty. Either you say fine or you say penalty for late registration. Sometimes they can also charge you for potential loss revenue if you do not file tax. How much you have paid can be fine with it, but the up and down of the story is that you will pay penalty for late registration. So if you don't know anything to write, I thought you must either say pay penalty or pay fine for registration, and that will earn you a mark in that respect. Any question on that? VAT. People of God. Any question on that? Hello, people of God.
Yeah, sorry. Afi, what did you say the will be?
That there must be a penalty or a fine if they do not register on time.
Oh, okay.
Penalty or fine, as in you cannot remember anything. You cannot remember the details. You must mention that there is a penalty or there is a fine. Do you understand? You can't say I can't remember how much. You can't say I can't remember how much and not write anything. You must write that there will be penalty or will be fine, for paying late. That makes sense, right?
Yes, it does.
Thank you. God bless. So if you have any question, you can the office. They don't allow us to use phone in the office, so my phone is always on flight mode when I'm in the office. So I always put on my phone during my lunch break or when I close. And when I close like 5 p.m. 5 p.m. will be like, is that not 12 midnight? Yeah, 12 midnight in Nigeria. So, but weekend, we don't go to work. So I'm always available on weekend. All the best of luck for the people that are writing exam, people that are preparing, keep solving questions. Love with you guys. Have a good one.
Thank you, sir. So Alfred, please don't forget last week solution. You should send it on this week's solution, this Excel sheet that you used.
Did I? Oh, I didn't use Excel sheets this time. I used Word document. I'll just send the Word.
Yeah, the Word document.
But I think I used the one. Okay, I will send it. I'll send. Let me just send it now.
All this and this your updated revision kit.
Hold on. Don't go. Let me just send it before we.
Okay.
So immediately you leave and I start something else like this. I have one job I need to do from house. Immediately I start like this, I'll forget everything again. Just hold on. Make sure you receive it before you leave. Let me take you so you can see my screen before you now see. Let me see. Come on now. Where is it? TX? Just send everything together. Okay. This FX. Where's the answer? No. The two answer. Where is the textbook? Oh, Jimmy textbook. Okay. Actually, did we use Excel last class? At least I can still see this one. Oh, I have to save and exit first. Send it. Okay, I think I sent those ones. The kit, that's the kit that I sent to you. And then let me check for the last class solution. I can't remember where I saved that. I hope I saved it because I was in a resort that day. Where did I keep it? Oh, this FTX. First time, man. Yeah, it's FTX. I don't know where I kept that other one was. I'll look for it and send. For the last class answer, I'll look for it and send. I can't see that one immediately now. So, have you received the two that I sent?